Hello and welcome. One of the biggest talking points in the Indian stock market is the ongoing general elections. This is understandable. Investors have put their hard-earned money in the stock market because they believe in the India growth story. Naturally, they want the government to enact policies that will boost economic growth. This will result in higher corporate profits and thus higher stock prices. More importantly, they don't want the government to enact policies that will stifle economic growth in any way. This point brings us to the main topic of discussion among investors today. What will happen on 4th June when the election results are announced? Before we move on, please note that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now broadly, the market believes the current government will return to power once again. At least that's what the market is pricing in. This means if the Modi government is elected once again with a majority, the markets will rejoice. We will probably see new all-time highs on most indices, including the Nifty and Sensex. But what if there is a negative surprise in store for the market on counting day? What if the government falls? Or if we get a hung parliament? This is what many investors are concerned about. Markets hate uncertainty, and this kind of political uncertainty can spook many investors. To answer this question, let's look at history. The last time a government change at the center caused a crash in the stock market was in 2004. This was when the markets were expecting the Vajpayee-led government to return to power. Instead, the country got a new government, the UPA. The markets were spooked because the UPA government had communist parties as alliance partners. The fear at that time was that the new government would implement economic policies that would hinder India's growth. That fear proved to be misplaced. India registered growth in excess of 8% and even 9% up to the global financial crisis of 2008. The stock market soared. The Nifty and Sensex multiplied nearly 4 times over the next 3 years and 8 months, from the day the election results were declared till January 2008, when the bull market ended. Mid caps and small caps did even better than large caps. In fact, if you look at this long-term chart of the Sensex going back to 1986, you can barely notice the crash that happened in May 2004. The lesson here is that a change in government is not likely to cause the bull market in Indian stocks to come to an end. That will only happen if the new government comes in with a highly regressive economic agenda. Now it's important to understand that ever since liberalization of the economy in 1991, no government in India has followed regressive economic policies. Some may have done better or worse than others in specific aspects of the economy, like growth, taxes, or inflation. But all governments since 1991 have steadily opened the economy, implemented progressive economic policies, built infrastructure, and reduced regulations that prevented fast growth. This has resulted in steady GDP growth that has been around 6 to 7%, a little higher at times and a little lower at times. In conclusion, we can say that economic progress in India is now irreversible. It is highly unlikely that any serious Indian politician wants the economy to grow slowly. This is because the people in their constituencies, especially the youth, want the opposite. That is fast development, higher incomes, and more upward mobility in their lives. Whichever government comes to power next month, in whatever form, either single party or coalition, will continue to implement policies that will drive the Indian economy forward. They have no other choice. This will result in higher corporate profits and thus higher stock prices. Investors should not worry too much about the election results and focus on the long term. Instead of thinking 1 month ahead, think 1 year ahead and 1 decade ahead. During emotionally charged times, like general elections, it's easy to worry about the short term. But if you look a few years ahead, your worries will disappear. Remember, Those who bought stocks in May 2004 created huge wealth for themselves. Thank you for watching.